this is Don Kaufman, and you are watching the TheoTrade Weekend Update for November 15th, 2019. Once again, we're discussing a fearless marketplace. Yet, at the same time you say that, there's just this myriad of risks out there. If you're kind of in tune with markets, you're pretty sure that any second, a tweet is going to come on the horizon and just rock the markets by, 3 to 5%. And that's the fear that you have to deal with, especially on an intraday basis. The other thing that we have to deal with as traders is the fact that, no one really likes the idea of buying markets all-time highs. That's, again, it's the question that I kind of get day in and day out. People are like, who is buying this marketplace literally at an all-time high? And the answer is, it's more hedging activity that's driving us a little higher per se than it is, somebody going out there and being like, wow, I really got to buy this marketplace, at 3,100 and change. So once again, we're going to close effectively at the all-time highs, but there have been some really interesting developments in this last week of trade, which, if you look back at this last week of trade, last weekend I kind of called it groundhog trading session. Well, there have been, again, some significant occurrences. One of those happened to be none other than the bond market. So the bond market, which was getting smoked last week, it rebounded a bit this week. And it has everything to do with keeping the 10-year right in around probably that 2% threshold. In a few minutes, we'll show you a couple of charts on that one. But because the bonds, they really got up right to that threshold of about 2% and kind of backed off again, what that effectively did, we had rising interest rates last week. This week, rates kind of backed off or even stalled out. That effectively completely stalled out the financials. And the financials are in large part what really kind of drove this last leg of the rally. So at this point in time, all of a sudden, the financials, count them out. And with the financials, you can count out the Russell as well, because most people are not familiar with, the Russell is filled with kind of mid-cap, like regional banks. All right, so the Russell being filled with banks, the Russell stalls out, doesn't do a whole lot this week. In fact, net, the Russell is going to be massively unchanged throughout the course of this week. The financials, count them out. Okay, so what gives? What is causing now this marketplace to continue to rise to the upside? Well, that's actually what we're going to detail here in a moment. Is we're going to look at a couple of individual stocks. You almost feel, by looking at these stocks, you almost feel they have just completely, they being, fund managers, traders, people have completely run out of things to buy. Take a look at Apple. Obviously, people have looked at a chart on Apple. Here's one, maybe it's not on your radar screen. Lululemon. Come on, yoga pants. Those things are never going out of style, right? Take a look at Lulu. I mean, Lulu is breaking to the upside like you think it was Roku. If you haven't looked at Roku, that's one worth looking at. Tesla once again is in play following its last earnings announcements. Even Microsoft. We're getting some mega market caps that are breaking to the upside, specifically Apple and Microsoft. And right now, that's it, people. That's what's carrying the S&P 500. Add a little healthcare in there. Healthcare had a astounding trading session specifically today, and that is the makings of the rally inside of the S&P 500 this week. But the rally this week, it's not nearly as far as you would have anticipated. In fact, we're going to get very SPX specific here in a moment, and you're going to find out that yes, everybody's talking about all-time highs, but for the most part, we kind of meandered most of this trading week and kind of listlessly drifted, if you will, to the upside, specifically on Apple and Microsoft. Again, moving forward, right? It's all about the bond marketplace. The bond marketplace, and specifically the 10-year. Again, we're going to detail those here momentarily, along with quite a number of trade ideas. Stay with us and enjoy what we're about to show in a couple of charts. To the charts and trades we go. Once again, a fearless market ignores an absolute myriad of risks that are on the horizon. People, we just belong to this negative gamma climb to the upside. But one of the first things that I want to point out here in quite some detail has everything to do with what I often term the mother of all products, and the mother of all products being none other than the SPX. I've been talking extensively, and we've been talking about this for years, which is the EM, which is the expected move, but the efficiency of the expected move in the last few trading weeks, it's like nothing we have ever seen before. People look at this rally and they're like, it's the most astounding thing I've ever seen, but it is more orderly, okay, than we've ever seen prior to this. And when I say orderly, okay, I'll just give you a quick example. The expected move this last week of trade, that's the week that literally the marketplace just closed 9 minutes ago, right? We were expecting about a $29.80 move. What was the actual move? Well, you can see the marketplace closed right there, 31.20, right? 31.20. The edge right there, that edge is 31.23. You have to recognize this is a $3,100 product, okay? And we're closing within what? A few points, a rounding error away from the edge of the expected move. It's not just this week. It's the previous week where we literally touched it, closed just off it. It's the previous week where, again, we were outside by about $8. It's the previous week where we literally closed on the edge of the expected move, okay? It is uncanny how effective the edge of the expected move has been on a week-to-week basis. But as I was saying a moment ago in the video portion, I was like, people are talking about it's a blistering rally to the upside. Okay, quite frankly, the marketplace did, and quote me on this one, nothing. Literally, this was the line where we actually ended last week. The marketplace did nothing this week until effectively on Friday when it decided to take a shot at the upper edge of the expected move. Now, it's what it comes down to, a whole lot of nothing inside of the SPX, followed by what? The marketplace is actually finishing less than 1% to the upside, specific to the S&Ps. Now, before I go any further, next week, okay, and I don't have the expected moves drawn yet on the SPX chart, and we will be drawing these here momentarily, okay? The expected move is coming in a little bit higher. By the way, it's still in flux because technically the SPX, these options are still open, okay, 15 minutes after the close. So they still have about 4 minutes left to trade. And it's still kind of centering that expected move. It's somewhere around $32 in change, which, again, this is an important takeaway, okay? Because what we have here is a marketplace that's going up. And typically when the market's going up, what is happening to implied volatility is going down. But last week we had a $29 move. This coming week we'll have about a $32, almost $33 move. Why is the volatility expanding out? Well, most likely the marketplace anticipates a bit more risk. We can go over to the calendar, we can dig into this, okay? But net, I would take the assumption, and this actually leads us back to, of course, the title over here, Fearless Market Ignores a Myriad of Risks. I think the marketplace is anticipating, okay, highly anticipating news specifically out of the China deal. So trade war, more trade war talk coming this next week. I mean, listen, if they're going to get it done, they're going to get it done before Thanksgiving. They're going to get it done either this weekend or they're going to get it done effectively next week. And that could be just a tweet-twastic kind of week. Now, let's kind of continue forward and then we'll start to show some of the other sectors in here. The bonds. Let's actually jump over to bonds for just a moment. The bonds, they recovered. Okay, and they recovered in a decent way. So the bonds were getting absolutely slaughtered last week. It was the big topic of conversation, and the bonds kind of recovered. Why was it such a big topic of conversation? Because it's driving the interest rate, right? So this is something, again, I detailed last week, as the interest rates, literally last week, they jumped, and they jumped just shy, okay, of about 2%. Now, 2%, a lot of people tell you that's a critical threshold. Now, I would actually agree with that. When you start to get that 10-year above 2%, everybody gets nervous about what? Everything from housing, okay, to the consumer, to credit card debt, to, every type of debt is pretty much resonating off of this 10-year. So we get close to it, right? We get close to it, and the moment we get close to it, we backed off again. Now, the moment that the interest rates, okay, start to cool back off, what does it do to the overall marketplace? And one of the answers is, well, the financials are going to stall out. So when I start talking about financials, what do we want to look at? Okay, well, we can actually cruise down specifically to the XLF. The XLF totally stalled this week. Okay, when I say it's complete and total stall, I'm not kidding over here. The financials totally stalled out. They are now sitting below the 30 mark. Now the financials are what carried the S&Ps. If we take a look again at the S&Ps, okay, you're like, oh, but this is still a pretty good leg up. Yeah, but the financials actually carried us this far. This last real boost to the upside, specifically today's trading session, this was all about mega market cap. It was Apple. Okay, it was Microsoft, even Facebook and Google got in the ring. This was the monsters of tech, but I'm going to tell you right now, the monsters of tech, they're not going to get it done. They're not going to take the S&Ps to a completely new leg higher. Okay, looking at the monsters of tech, stuff like Google, which totally broke to the upside. Okay, stuff like, again, Apple, which Apple has already had a wicked breakout to the upside. Again, I'll show these and detail these again a little bit later. But when you start to look at them, you'll actually recognize, again, this could actually be a little bit of a last gasp in a number of stocks, not necessarily the entire marketplace yet, because again, the argument that I'm trying to give you here is that the S&Ps specifically, okay, hinge much more on the financials, and those financials stalled. The other thing that you need to be mindful of is the Russell. The Russell is completely flat on the week. In fact, when I apply auto expected moves, all right, here's some auto expected moves as I just applied them. When I say auto expected moves, the reason I'll use this from time to time, it shows you this is the start of the week. Right there is the start of the week. Net, what do you have in the Russell? They're actually going to close down very mildly, or as I said a moment ago, they're massively unchanged on the week. As were, again, if I pull up the financials, okay, the financials closed ever so slightly down on the week. Again, think of the financials in the Russell most of the time kind of moving a little bit in like lockstep. From a sector standpoint, though, things are getting a lot more interesting over here because you have the financials that stall. The Russell's flat on the week. And then the energy sector. Okay, let's not forget about the energy sector. The energy sector was wicked, just wicked lately to the upside. It backed down a little bit last week and actually continued to see some sell-side activity. Once again, if I apply auto-expected moves, one of the things that people probably were not aware of, okay, after seeing some stellar movement, okay, to the upside inside of the energy sector for a brief moment, okay, specifically yesterday on Thursday, it cracked to the downside of the expected move. Obviously, though, you're thinking to yourself, well, who cares? Who cares? It's not impacting the S&Ps yet, but you should care because it will, right? It absolutely will. Not energy alone. You have the Russell now flattening out. Okay, you have the financials flattening out. You have energy backing off. Okay, this is another one that I'm actually keying into a little bit here. It happens to be Walmart. Okay, Walmart. Oh, it's so fun discussing Walmart, right? Walmart passes through earnings. Wicked reversal, though, inside of Walmart. In fact, on an intraday basis, has seen nothing but sell side over the last two trading sessions. Again, after releasing earnings and cracking to 125, is now actually trading at 118 on a percentage basis. It's a pretty astounding move. And it brings into question, all right, the consumer, and specifically consumer staples, which actually brings up the XLP, consumer staples. Now, the thing about consumer staples, okay, these are largely impacted. This particular ETF is largely impacted by Walmart, which I think is somewhere around like 9% of the consumer staples off the top of my head. But the biggest constituent of this group is like Procter & Gamble. If you take a look, okay, we'll go take a quick glance at Procter & Gamble. Procter & Gamble, it hasn't had a bad week. Nevertheless, okay, in consumer staples, you really have to think about Walmart. And again, the impact that's going to have in just the days and trading days to come to the XLP. As such, I've actually taken a couple of in-out spreads specifically in XLP. Okay, you can see I'm loaded. I've got inventory. Here, bearish inventory specifically on the XLP. Looking at this from the perspective, and let me give you a little bit of insight. Okay, I'm actually standing back and saying that, listen, I know I missed Walmart because I didn't want to be involved in the earnings. No one saw that wicked reversal coming. So I'm late to the party, right? So instead of actually being late to the party here in Walmart, okay, I'll be early to the party inside of the XLP. If Walmart's going to continue to take a hit, which it looks like it's going to, then no doubt that the XLP will start to be impacted, and that's why I'm putting an in-out spread inside of the XLP. The other one that really is a standout, I was talking about mega market cap kind of carrying this marketplace, okay? you really have to look at Amazon this week because it kind of fell off everybody's radar screen. Nevertheless, it also had a statistically substantial move. It actually broke substantially outside of expected move. So it's kind of become Mr. Toad's wild ride inside of the last couple of trading sessions. Again, in the very near term, there's been some heavy sell side activity specifically to Amazon. Again, calling into question a number of aspects. Now, Amazon's in the news continuously. Okay, it's in the news for it didn't get the government contract, it didn't get this. Okay, but is this the beginning of a weakening consumer? That's the question that you are kind of left with in the trading sessions. Because again, if it were just Walmart that were down, I wouldn't question it. But it's also Costco. Okay, Costco's playing a role in this. Costco's actually off again some recent highs and just backing off again, maybe seeing a little bit of a reversal in the days to come. So you got Walmart, you got Costco, you got Amazon taking a hit. All right, let's actually switch gears before we look at a couple of stocks. The VIX subsides, but volatility in the VIX options is on the rise. Again, VIX subsiding. What does that mean? All right, well, let's actually break it down for a second. The VIX, here's the VIX. Way down, people. We actually are back down to the 12 level in the VIX. Now, everybody that looks at the VIX goes, wow, that's really, really low. that's the best you could do. Wow, that's really, really low. First and foremost, it's not that low. If you open up like a 3-year on the VIX, okay, I'll go back in here to 2017 when the market was hitting all-time highs, okay, and we had a VIX of what? 8, 9, continuously. There were months when this thing didn't get above 10. Literally months didn't get above 10. So net a VIX is at 12. But here's the interesting thing, okay? The VIX itself is down, but back month volatility, when I say back month volatility of the future, right, is still hanging pretty tough. Let's look at February, for example. If you look at February, it's still at 15.2. So what are you actually looking at? Okay, so the VIX, by the way, is 30-day volatility. But if you look in the very near term here inside of the spiders near term, everything's about 10%, right? The back month is sitting where? About 15%. You realize that there's like a 50% in some case, like volatility discrepancy between front and back month. I mean, you go a little further out in time. You start looking like 100 plus days out in the option market. You're all the way to like a 16 volatility. I mean, we're talking 50 or 60%. And this is not like, if you saw a $10 stock versus a $15 stock, you'd say, yeah, whatever. It's $10 stock versus a $15 stock. Yeah, but in this case, we're talking about volatility of the entire S&P 500, which says here and now, nothing is ever going to happen. And then in the future, they're telling you like, no, the world is possibly going to come apart at the seams. Now, it's always like that. Like this is normal, but it's exaggerated right now. One of the reasons that I'm the topic for this weekend's update is very specific. A fearless market ignores a myriad of risks. It's not completely ignoring the risks. Okay. And when you see a low VIX, I think you're really being misled. Let me show you also why you're being misled by the low VIX, because the VIX options themselves are actually having a rise in volatility. So where that kind of comes into play right here. Look at the volatility of the VIX options. This is the VVIX, the VVIX. And if you take a look at the VVIX, what does it see? It sees a very continual rise. That is, professional traders are actually buying VIX options. And by buying VIX options, they're actually raising the implied volatility of the VIX itself. So here's a great kind of catch-22. I told you, there's a whole lot of risks on the horizon here. You have the VIX, all right? Okay, the VIX, that's literally, it's coming down. Okay, but then you have what? VIX vol, and it's, that's going up. Where are you left? You're left somewhere between a rock and a hard place in the middle over here. I mean, we're on a giant teeter-totter just waiting for the next tweet that's either going to rock our world or totally rock our world. But again, you have to be very mindful when the professional world is telling you something right now. Okay, if they're telling you, it doesn't matter that the market's going to all-time highs. Okay, they're actually buying up some volatility very quietly in the backdrop of this marketplace. Doesn't matter that the VIX is going lower. Okay, it just matters that the professionals are actually hedging off some of those risks. All right, onward and upward. Now we move into what we call stock chop. All right, I'm convinced right now that the marketplace has run out of, well, crap to buy because there's nothing else left out there. What are we actually buying these days? You have to take a look at this for what it's worth. Go take a look at GE, okay? This thing is like a launch trajectory to the upside. Now, I always like to dictate where I am carrying positions. There's no question I am carrying a position inside of GE. I'm long 1,000 shares of GE, selling premium against my GE. All right, so I am long GE. Another stock. Again, when I say running out of things to buy, this does not indicate that this is a stock per se to buy right now. I just wanted to show, again, a number of players. It's like, GE was thought for years to be like the dog of the Dow. Okay, well, they can't get enough of it. I mean, when you start looking at this, though, on a percentage basis, these are astounding moves. I mean, this thing was only up 10, 11%. Just what? 2 weeks ago? 3 weeks ago? It's now up 43% on a year-to-date basis. Stand back, people. Okay, not done. Go into what? What else we got? All right, Altria Group. Which, again, I am carrying a position. Yes, I am carrying multiple positions in here. I am actually long. Again, I am long Mo. Long Mo. Here's another one after the, after some of the debacle with vaping. Here's a stock that was down almost 20% that is now effectively, well, almost flat on the year. It's almost a 20% run in a very short period of time. But that's why I say you almost feel like they're running out of things to buy. Here's one. And again, I'm not necessarily saying I would put a trade specifically into Mo right now. Another one, okay, happens to be none other than Caterpillar. In terms of Caterpillar, huge run to the upside. Now, let me clarify something. I got cat fever the opposing way. I'm actually in short positions on Caterpillar and continue to, this is like a love-hate position. I love to hate on Caterpillar right now. I've actually been in a short Caterpillar position for years now, and it has been a very profitable position because we initiated the position all the way back in January, early January of 2018, and I've actually ridden Caterpillar short. But when I talk about things that there's nothing left to buy, Caterpillar may have already rolled over. This is absolutely still an applicable short position for you. And last on this list of, like, when I say they've run out of things to buy, you have to look at healthcare. Now, this was mentioned, healthcare was mentioned by, politics. The administration today was all over it. Healthcare just had an absolute breakout day. If you're looking at the S&Ps and you see that they're up 20, okay, and then I talked about financials aren't doing anything, okay, and it's all about mega market cap. Well, what gave them a little boost is the healthcare sector today. There's no question about it. Healthcare is up over 2%. This is one we're going to be looking for a number of positions in the days and weeks to come. All right, other positions that I've actually taken on. All right, here. Want a hideous beast? Right there, okay? This is actually the marijuana ETF. Now, listen, no fundamentals, push them all aside, okay? The volume inside of this ETF has been nothing less than phenomenal in comparison, okay? This was actually, pull up a full inception chart over here. This is the lowest point since the MJ ETF has been offered. Now, listen, I've looked at Tilray and I've looked at, CGC and Canopy Growth. There's no way I would invest in any individual, marijuana stock for growth, value, or otherwise. But this ETF right now begs me to take a position, and I've done just that. I've actually gone out. There aren't even weeklies in here. I've gone out. I've actually sold a few puts, and I've actually purchased a few shares in here. Net, I want to get long somewhere around about the 15 level. So how do I get long at the 15 level? I sell the 16 puts. I actually sold those things earlier today, right? In fact, again, I'm kind of staggering into positions, but I put these things on for right around 70 cents. That's pretty much where they're trading right here, right now. If I get put the stock, and by the way, to get put stock now costs absolutely nothing at most brokerage firms because there's no more exercise or assignment fees. So if I could put the stock, so be it. I want to own the stock. I'd get put the stock minus the put that I sold. It would get me long at about 15.30, just in case though I also went out and bought a few hundred shares. Okay, next one I am looking at. Yeah, this one's getting beaten up as well. Uber. Nobody has wanted to touch Uber. I do. I have no positions in here. I continually have tried to sell puts in here. Okay, I'm trying to get long Uber somewhere around the 25 level. So that's something I'll continue to work. All right, another one over here. Cisco. I'm out. I'm out of the contest, right? So in terms of Cisco, I have been short Cisco since April, okay, in the 55 plus level. I have now exited my Cisco position as it actually dropped all the way down to the 45 level. In fact, we exited on Thursday our duration position in the 44 handle. All right, okay, last couple of stocks over here, none other than Lulu. Lulu. Okay, this is not an easy one to talk about because I am actually in a short position in Lulu and getting run over here. You would think that they have reinvented the yoga pants. Has a lot to do, obviously, with what's going on inside of Nike versus Amazon as well. Nevertheless, Lululemon bursting to the upside. I'm going to look to reinitiate a very mild short position in here. Nevertheless, I'm going to look to reinitiate a short position as this thing has effectively broken to the upside. And last, but definitely not least, by the way, I was mentioning how Lulu and Roku apparently have a whole lot in common, more than maybe we know. You know, you would think like Lululemon, what are they like? They're not just reinventing yoga pants, but, you know, they're curing the entire world. Roku, the same thing. Roku looks like a wicked short squeeze. And last but not least, none other than Tesla, which is, if it's not on your radar screen, it's back in the game. Tesla is once again, and you have to open up a 3-year to effectively see this, approaching all-time highs. This is something that we have very successfully traded in the past, and we'll continue to look for more opportunities inside of Tesla in this next week of trade. Listen, there's a lot to think about inside of this weekend's update. Just keep in mind, all right, if you're not hedged, get hedged. This marketplace just feels fearless, okay? It's ignoring all the risks that are on the very short-term horizon. But at the same time, you just feel like you're that one tweet away from, like, you know, utter and sudden destruction. Well, yeah, keep that in mind because it's real. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.